The following is a presentation of TFNN. Live at TFNN, The Money Masters. Now, The Money Masters.
Good morning, Money Masters and Treasure Hunters. Welcome to the Money Masters Show. This is the Tuesday, February 12th edition. Thanks so much for joining me. I'm your host, Steve Rhodes, and let's go take a look at these markets out here. We've got the Dow up 34 points right now, trading out at 14,005. The S&P up 2 points, trading out at 15,1920. The composite up 89 cents, so a flat morning in the composite, just getting moving. You've got the Russell 2000 up about 0.3%. That's up about 2.5 points. Microsoft up a tick, Intel up 7, Google up 5, about $4.30. Apple down $2. We'll take a look at those charts as well as anything else that you'd like. Our call number is 877-927-6648. Things on the move this morning. You've got Coors, Michael Kors. Not the beer, but Michael Kors up $5.68. That's having a nice 10% pop in the market. Fossil, FOSL up 5%. That's up $5 and a change. Percentage-wise, Avon Products, AVP, and Masco being the two big leaders percentage-wise, up 15.4 and 12% respectively. To the downside, Dun & Bradstreet leading things to the downside. Down $7.50. That's off 8%. Valspar off $5. That's off 7.5%. Cubic Corp, CUB, off about 8%. Level 3 Communications down 14%. Also, you've got Qualys Inc., QLYS. They're down 16% this morning. That's off $2. Again, our call number 877-927-6648. Let's go take a look at the indexes here. We'll start off with the S&P 500, trading out right now at 15,1866, up over the swing point from February 8th. That high was 15,1831, as well as up over the swing point high, or the swing point, I should say, the candle from yesterday as well, 15,1831. We'll see where this finishes out. It has not tested the 15,1441. That is the swing point high from February the 1st out there. Actually, from a bullish standpoint, you prefer to see a test of that level and a rejection, just simply because it's an area of potential prior resistance out there. And we know once you break through an area of resistance, it turns into support. Only one test out there. The futures contract, on the other hand, did test that level. Where, if this 1.272 butterfly fails, where is it going to move to? Great question out here. It's going to move to the 1.618 level. We take a look at that. Your price point, I believe it's right around 15.55 or so. But let's take a look at the exact number out here. That would be the expansion of the September 14th swing point down to the November 16th swing point. 15.56 would be the number. I'd say today you get it close in that 15.20-ish range out there. That is where the S&P will want to head. It is not yet on the daily basis. It's making new highs with less relative strength, but it is not yet in the overbought territory on the daily chart. Really, the last 5-6 trading sessions have helped to work off some of that condition out there. That is on your S&P 500. Let's go take a look at the Dow. The S&P is leading the charge here from a standpoint of being up over that February 1st swing point. If we take a look at the Dow, that is what is going to get tackled here today. It looks like that's what will get tackled here today. That price point on February 1st is the 14,019.78. A couple days ago, okay, so we're going to use that out here, 14,022.62. I suspect that's where it'll try to tag, trading out right now at 13,999. You can see the Dow here, just if I switch over and take a look at what's moving and grooving inside the Dow, to the upside, being led by Caterpillar, Travelers Company, and home side, you've got Coca-Cola, Cisco, and Merck and Company. But really, it looks like mostly Coca-Cola and Cisco putting the negative juice inside the Dow. If, in fact, the Dow breaks through this 1.272 butterfly pattern, it, too, would make a run up to that 1.618 expansion. Won't do it overnight, or shouldn't do it overnight. That level out here would be all the way up to the looks like about 14,383 or so. That is on the Dow. Let's go take a look at the Russell 2000. On the Russell 2000, that is trading up a bit. Give me a moment here to pull this back. This is, well, not as you know. Give me a moment here to redo this. The Russell 2000 trading up over the swing point high from February 1st. That level's 912.76. You closed back below it yesterday. That was a test of it. The Russell 2000 really just showing nothing but strength out here. It's up over the 1.272. It's cleared it pretty well. The 1.272 level right around the, we're going to call it about the 896 level. Right now trading out at 915. So the Russell 2000 really making a statement that it wants to go take a view of the 933 level. That would be a 1.618 butterfly pattern out here. Let's take a look at A to B equals CD off of November 16th. That would be your low. Your B point on this would be December 20th out at 852.42, and then the pullback here, a 1-to-1 it's completed a 1-to-1 A to B equals CD right now. 916.60 is the actual number. 915.73 so far is the high of the day, but that retracement is so shallow, so low. The 1 to 1.272, let's see where that takes you to. 1 to 1.272 would take you right up to about 940. So you've got two patterns that would complete at about that 933 to 940 level. Let's go to Marie in Erie, Pennsylvania. Marie, thanks for calling. Thanks for holding. How are you this morning?
Oh, I'm terrific.
That's great. Did you get any portion of that snowstorm that traveled through the Northeast over the weekend?
You talking about Nemo?
Yeah, Cat's right. Yeah, Nemo. How about I forget that they go ahead and
they name those things.
That's right.
The silliest thing I ever heard, but that's okay. We only got the back side of them.
Okay, so that means just a little bit of snow, or?
Yeah, we got about 4 inches.
Okay, all right. So
Not
4
bad.
inches, and that should dust away pretty quickly.
Yeah, in Erie, we're used to a lot worse than that.
Okay, well, good. Well, good. Glad that everything worked. Well, it had to be pretty. 4 inches would make it pretty nice around there, I would think. At least the day that it was snowing.
Yep, it's we can't complain this winter. It's been pretty good for us.
Well, good. You wanted to take a look at the DBA, which is the power shares for some of the commodities out there. Is that correct?
That's correct.
Tell us what you're doing and how I can help.
Well, right now I'm just watching. I was wondering if this is going all the way back to where it broke out last summer. And, and obviously what I would have to wait, if I wanted to get in, and wait for a sign of strength, right?
Well, one of the things, the DBA, what I would do, so if you're interested in trading the DBA, what I would first do is I would go over to the PowerShares website, and I would download what the holdings are inside there, because it has changed over time. So it has not remained consistent, which makes it sometimes difficult when you take a look at ETF, when the underlying component or the underlying components change. It used to be primarily, I think, wheat, corn, maybe sugar. There was a couple, there's basically 4 commodities that made up the bulk of it. And I don't know if that's the case or not because I haven't traded that. But that would be my first recommendation. And, maybe I'll go look during a break, which is not until about 4 or 5 minutes from now. But that's one of the first things that I would do. If you're trading the DBA, you want to make sure that you, just like any ETF, what you want to first do, Marie, is make sure you understand what the underlying instruments are. Because from the underlying instruments, you can then go ahead and make your trading decisions. You want to take a look at the patterns that are setting up there.
Okay.
So what it won't really tell you, unfortunately, I don't think there's a way to find out, is what were the instruments in here, I guess going back to that last set of swing points. Has the DBA been consistent, maybe weighting-wise it's a little bit different, but has maintained the same instruments inside that since June 1st, 2012? Because that's the area that you're asking about,
right,
moving back into. And so that would to me be the only way to really be able to trade this, is understand what the underlying instruments are. So, and I don't know what that is.
That's okay. I haven't traded it much. I was just noticing that a lot of commodities are in a downtrend.
Sure.
And where are they heading to? And And, you know, what does this mean overall?
Well, you've got commodities are priced in dollars, right? So, you know, part of putting that together is then understanding the U.S. dollar index. Now, that in itself requires you to understand what's going on inside that basket of currencies.
Right.
So you've got 57% of the U.S. dollar index is based on the weighting structure between the euro-U.S. dollar. And then you've got the pound and the yen and the Canadian dollar represent about 80% of that. So right now, if we take a look at the U.S. dollar index, it's had a nice move and should be headed up towards its resistance level, which is going to be the November 21st low, which is about $80.94. So it's had a nice move up off of the bottom, pulling back today. That just means that the euro here is bouncing. But it looks to me like the U.S. dollar index will release information to you, Marie, and mostly about certainly some of the elements of that DBA trade are going to be based upon what is really going on in the U.S. dollar, because you've got the commodities inside there are certainly going to be priced in dollars. So as the dollar index gets up to that November 21st level, and you may not get the data feed on the U.S. dollar index. ICE charges a ton just to get that one index out there. It's like $90. But you can take a look at UUP. But on the U.S. dollar index, if it gets up to the resistance level of November 21st and then begins to back off, we'll see the U.S. dollar index really in a trading range. So that's, in essence, one of the things that you'd like to see. You'd like to see the U.S. dollar index get up there, reject that area, and then start pulling back. Then I would think that the DBA also would start moving higher as well. So does that help you, kind of put that stuff together? Yeah,
quite a bit, because, it seems, I was also looking at the UNG, and that's retracing down, and
yes.
And oil, I know that oil and natural gas don't run quite together, but that's come down a bit. And I realized the dollar had gone up, but this dollar rally has been kind of pathetic in my in my impression. I realize that it affects the prices of these commodities, but
yeah. Well, if you do take what the dollar has done here, which is important too, and my opinion is important to understand, is if you take a look at the U.S. dollar index on the monthly chart, one of the things that it has done is it's broken out of its downtrend channel, and it did it with conviction back in May. So even though you've got printing presses rolling around the world, you did have the U.S. dollar index break outside of that channel. And if we take a look at the weekly chart here, the weekly chart had also started a little bit of a rising price channel. And it looks to me like with the U.S. dollar index, it's got really good support down at the 79.63 level. It's at 80.19 right now. It looks to me like what the U.S. dollar index wants to do, like anything that breaks a price channel, wants to go back and test it. What level that's going to be at is 82.50, 83, or something like that. So the U.S. dollar index is really not looking that bad out there. I'd rather be holding dollars than euros at the moment. So, of course, really, I'd rather be holding yen than dollars.
Okay.
All righty.
Thank you so much.
You bet, Marie. 877-927-6648. We'll be right back.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
Welcome back, folks. You got the Dow up 27 points right now. And, and going back to Marie from Erie, Pennsylvania, her question about the DBA. During the break, I went over to the Power Shares ETF website, and I went ahead and pulled up the DBA. So if you take a look at it, and this is what you want to do in any ETF that you're trading. You want to make sure that you understand what the underlying instruments are. All of the ETFs will give you typically they'll give you a little download, and I'm not saying that the DBA didn't here. They also had it on the front page down towards the bottom, what the weighting structure inside the ETF that you're trading. And so you want to make sure that you understand that before you actually enter a trade. Now, in the case of the DBA, this is through yesterday, the largest single weighting inside there is live cattle, represents about 13% of the actual ETF. You've got other things. You've got cocoa makes up 11%, coffee makes up 11%, corn makes up 11%. You've got sugar makes up about 13% as well. Soybeans around 13%. And so those are the DBA is a split of those, and you really need to take a look at patterns inside the commodities in order to be able to understand where the actual DBA is going to, as opposed to trying to match up the DBA itself with an existing pattern that's out here. So make sure whatever ETF it is that you are in or that you are trading, works the same way. If you're trading the FAS, make sure, or the FAZ, make sure you understand what that weighting structure is. It typically matches the XLF, but it may not match it exactly out there. If you're trading the DUG or the DIG, the energy sector, I think that does match up to the XLE out there. And you can always see what the weighting structure, and then you want to go to those items, the underlying structure, those instruments that make up that ETF, and understand what patterns are out here. If we quickly take a look, here is live cattle. I believe I get a delayed feed on live cattle out here, but I don't trade live cattle. So I don't trade the DBA because I'm not trading those commodities, and so that I don't really pay attention to to this set of specific commodities out there. Unlike natural gas or maybe oil, a little bit easier to trade the ETFs, because then you're just dealing with just simply one instrument behind that, and to me that's a whole lot easier to be able to trade as far as trading a vehicle out here. So that was on DBA out here. I'm not saying don't trade it. I'm just saying make sure that you are absolutely aware of the underlying instrument behind it. It'll make trading it a whole lot easier out here. Marie did mention natural gas, so let's go take a look at natural gas right now, trading out at 3.28. Natural gas is trading inside this descending price channel. Natural gas had been in this rising price channel. This was a subcorrection channel, really, that it was traveling in here. In the subcorrection channel, it broke through it at first. So that was your first break of the channel back on January the 2nd. Oftentimes when you break through a trend line or a channel line, what will happen is whatever it is that's trading will try to get back up inside it. That's exactly what natural gas did. Looked like it was a false break to the downside. Now it doesn't look like that. It looks like instead what was this subcorrection channel is now turning into an actual descending, or what's the actual word that I'm looking for? Anyways, descending, I guess, will work. Downtrend. How about a downtrend? I think that's a little bit easier. Instead of that didn't sound very good, did it? But anyways, you've got a downtrend price channel here now that natural gas appears to be traveling in, and you've got A to B equals CD patterns that you can easily draw. And in this case here, you can take a look at your A point. You can start up here at the swing point high in this, which came on November 23rd out at the 399 level, 393 level. That'd be your A point. Your B point was this little down thrust that came in on January 2nd. Don't know what was behind that, but that low was a valid low, $3.05 out there. That's your B point. And your C point out here would be, this is a larger A to B equals CD down that we're taking a look at. That would be the January 22nd high. The smaller A to B equals CD, that would take you from the actual high here on January 22nd. So let's take a look at that, down to the low that was put in on January 29th, and then back up the retracement that it did coming into February 6th. I suspect that is the first A to B equals CD down that natural gas wants to travel in, which will take it down to the bottom of that price channel. That being said, then you can take a look at that larger A to B equals CD down, and that is on natural gas, which is certainly a seasonal type of trade. But even though we just had that big snowstorm, and, we're already in the middle of February, I guess, right? Today's the 12th, yeah. There's only 28 days. We just have 2 more days until we are in the middle of February. Time is flying. You can't stop time, folks. 877-927-6648. No better time than to call into the show. The lines are open. We'll be right back.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the market, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insights subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Welcome back, folks. You've got the Dow up 22, S&P flat here, up 99 cents, composite down 81, small caps up $3. Let's take a look at the financial sector. We were talking about the ETF structures out here. So let's take a look at the XLF, trading out right now at 1776. And what I've got on my screen, if you're watching us on Tiger TV, if you are listening in on the radio or your mobile device, remember you can always catch the archive of this show on Channel 10. You'll be able to see the actual charts that we're looking at. If we take a look at the XLF, it is up over really a good resistance area. This is a weekly chart. That resistance area really set up by the highs that originally were put in back in April of 2010, right around the 1712 level. What the XLF has done is broken above it. It's trading at 1776 right now. It is doing it on lighter volume as it passed through that area. But we can take a look at the XLF. A couple patterns that are coming together here at about the same point. The XLF has been really strong. I suggest taking a look at the XLF once this market does make a retracement or a correction out there. And it will happen. And if we take a look at the XLF, if you come off of its highs going back to 2007, all the way down to the low that was put in March of 2009, the .382 retracement number is right around $18.19, $18.19. Now, if I go ahead and I pull the XLF back, we take a look at the current A to B equals CD. There's a couple patterns that you could draw out here. This A to B equals CD would be coming off of the October 7th low, when the XLF traded down to a level of 1095 out there. That's your A point. Your B point is the high of March 30th, 2012, out at the 1601 level. Makes a retracement. Looks like probably about a point. Let's go see what it is. Let's not even estimate here. It was about a 50% retracement out there. The 1-to-1 A to B equals CD takes you to 1837. So 1819 to 1837 looks like that's where it wants to head. Now, it did pass that B point on lighter volume. Substantially lighter volume, quite frankly. That volume on the weekly basis was 430 million shares, and as the best volume that this had coming into that level was 413 million. As it got up above it, rejected that level, but as it's gotten over that, it has not gotten over that with volume. Now, because of that resistance line right around the number is, it looks like right about the 1712 level. Watch that as the XLF finishes this pattern and then starts to pull back. Watch that 1712 level. If it can stay above that, test it with some light volume. That would set up a nice move here in the XLF. If it gets back inside the bottom of the range, then that changes things. That says that, okay, where it would likely pull back to would be that March 30th, 2012 level, that high volume, that higher volume, $430 million mark out there. That is at the 1601 level. That is on the XLF. Let's go to Johnson City, Tennessee, to our man Ken. Ken, thanks for calling. Thanks for holding. How are you this morning?
Hey, Steve, I'm doing good. I spoke with you once, I think maybe last week. I'm not sure.
I think you did. I think you did. Thanks for calling back. You wanted to take a look at Apple. Tell us what you're doing and how we can help you.
Well, I wanted to see if you could pull up Apple on a weekly chart, candlestick, and also put in a 10 and 30 week moving average.
A 10 and week 30 moving average. Give me a second here. That might
like a 10 and 30 week.
You're making me work like a dog here.
I just want you to see what I'm seeing right now.
All right, so give me a second here. We'll go ahead and put the moving averages in here. So moving averages, and you're using a 10-week. So I just need to change this to 10, number 10, and this one here you want as a 30. Now, you're using simple or exponential moving averages?
I use simple.
Simple,
in fact,
all right.
I use that. You know how people have, death crosses with the 50 and 200-day moving average? I like to use the 10-week and 30-week.
No problem. Okay, so we got 10-week, which is the equivalent of a 50-day, and 30-week, which is the equivalent, in essence, of a 150-day moving average. All right, so your death cross, if I'm right here, came in right around the week of November 23rd out there.
Yeah, and I wanted you to see, all right, see the head and shoulders on the weekly with the left shoulder, the doji head, overbought.
Absolutely.
And then the lower right shoulder, and then we busted through the neckline with volume, and then we're going back to test the neckline with lower volume. And that's what I see.
Yeah.
And it's picture perfect.
When we take a look at that neckline, looks like, this week or yesterday may have been that test. You've also got that the blue line on mine is your 30-week. That's what you use, right? You use 30-week and 10. Okay, so it's that 30-week or 150-day, in essence, moving average right now, and that level is 487.45. And
the neckline corresponds with that 10-week.
Yeah.
Is it the 10-week or the? I don't have it in front of me.
Yeah. No, I see what it is that you are looking at there. Now, folks, what you would do here is if you just simply now do this, we'll just go ahead and move it. I'm going to use a little tool here. I'm going to go from that little doji that Ken pointed out, which was the high, down to the neckline. Once you break that neckline, basically the move that you should be looking at, I can do it also as an A to B equals CD. But, your price projection, in essence, on that would take you down, and we'll just do it on the A to B equals CD as well. But some people don't have the tool to be able to do that. So if you are using those head and shoulders patterns out there, what that price projection gives you, which is what I'm estimating we're taking a look at, that A to B equals CD down gets you around that 339 type level. And it looks like,
that's what I see. And just to let you know, I don't know if you have CNBC on, but Apple is speaking right now at the Goldman Sachs technology conference, and it's all over the place. It's down right now, $6.
Is it? Well, they're not really talking about a Dick Tracy watch, are they?
Yeah, they're talking about rumors about their cash. They call it.
Okay.
We don't have a depression mentality when it comes to our cash. We're going to be innovative.
Yeah.
But it's all over the place right now.
I don't know about. Do you use any Apple products?
Yeah, but I've already got them all.
Yeah. Well, no, the reason why I asked is, I kind of heard yesterday some talk, as I was driving around, I heard some talk about the Dick Tracy watch out there. I can't even possibly fathom. Steve Jobs would have to be rolling in his grave if he heard that one. In my opinion. Now we're going to go from the Dick Tracy watch to the Get Smart shoe phone out there.
Yeah.
I love both of those shows, but I wear a watch. I don't always wear a watch. When I need to know what time it is, I more often look at my phone than I do at my watch, even if I'm wearing a watch.
Well, that's sort of why Apple is putting a lot of people out of business, because no one wears a watch anymore unless it's for style.
Yes.
They just look at their phone.
It's just, as a guy, we're pretty limited on the jewelry for the most part that we can wear. So a watch would be one of those things. And so I just, I used to, before, going back, I don't know, 25 years or what have you before. Well, even the original, do you remember the very first cell phone that I had was the brick, the real brick out there, that big Motorola brick out there. I don't recall there being any time on that brick. But now, cell phones is great. If I don't know what time it is, even during the show or what have you, I'll just click the button and see what time it is, not my watch. So
Exactly.
I do hope they're coming up with something better than that.
Well, I consider what's happening with Apple now, and that we're right there. I'm thinking that your 1.27 butterfly pattern may still be intact.
Yeah.
Because to get up to 1555 on S&P would have to contradict what we're seeing in Apple with that head and shoulder. But,
the problem, so the difficulty on the Apple on the daily chart is really because it's inside that gap. Now, today you're getting a little bit of a bearish candle out here. And what Apple didn't do, what I did point out to folks yesterday was the first gap down. And when I'm talking about the first gap, I'm taking a look at the one from January 11th and the gap down on January 14th, is that first gap, even on the Apple bounce out there, did not get all the way up into it. So it didn't close that gap. And so I don't think that Apple actually needs to close the gap. I mean, you could take a look at resistance, and you really take a look at that swing point from January 15th, and I think that becomes a really good benchmark. And that's what Apple actually did yesterday, was it got up into that. That's got 31 million shares. And yesterday on the bounce, it got up there with 18 million shares. The low of that January 15th level is 483.38. It got up to a high of 484.94 and closed back below it. So to a certain extent, without closing the gap, which I don't think that Apple will actually do, it could, but I don't think that it will do it on this get-go here, you can easily see that it ran into some resistance yesterday with inside that gap. And today it's giving you a little bit of a bearish candle out there. So that's that. My thoughts on Apple, no question, it's going to go down to that 339 level.
Well, so far the weekly candle is bearish. We'll see how it finishes out. But
absolutely.
It would be textbook if it had a bearish weekly right at that neckline.
Absolutely. No question.
On low volume.
Yeah, no question. Well, hey, thanks. Right, you bet. Hey, look, thanks for calling. Thanks for pointing it out and sharing with us your 10 and 30-day simple moving averages. I'm sure there's some listeners that are going to go apply that to some of the chart patterns that they're trading. So thanks so much for sharing. We really do appreciate that.
I learned that from the chief technical analyst at UBS, and
okay.
I actually, I use it a lot, and it works pretty good.
Yeah, that's great. So then do you use on a daily chart here, are you using a 50 and a 150 day, or are you using it really only on the weekly chart?
Well, weekly just to give me the big picture. I'm not an active trader day to day.
Yeah.
I don't have the time. I hope to one day. But,
yeah. Got it.
I try to just keep the big picture in mind. And
well, we appreciate that, and and thanks so much again for sharing.
Thanks a lot.
All right, you have a great day. Let's go out to Bill in Palm Harbor, not that far down the street, to talk about the S&P 500, I suppose. Bill, thanks for calling. Thanks for holding. How are you today?
I'm good. How are you, Steve?
Excellent. Thanks for calling. Tell us what you're doing or how we can help you.
Yeah, actually, I was talking about the SPY. But,
yes, okay, that's good. That's cool. We'll go right over to the SPYs.
Okay. I took some cash off the table back, when all the physical cliff discussion was going on, and I was out of town, and it ramped up. I took about a third of my portfolio in dry powder now, and I'm wondering, if I should get back in, or where would be a good entry point to get back in. I don't know if we're going to go back and close that gap when it ramped up. I think it was January 2nd or something. So, looking for a little guidance from you on that one.
Absolutely. So here's what I would do, because the market has not broken out, and we would take a look at volumes. The SPYs yesterday, the S&P 500 was probably the lowest volume day of the year out there. So certainly no conviction. You've got these patterns that are set up here. First of all, to answer your question, the best place to put your gunpowder in and take a shot is just simply whatever individual stock or ETF it is that you are trading. Your most ideal places to be adding to positions is when, if you just simply put up just the relative strength indicator out there, and where you want to be adding to positions is when it's down towards the lows, when it's down towards in that 30 range. That becomes your buy areas out there. Now you want to make sure that you've got some candles that coincide with that. And that means you want to see some type of bullish candle out there. So that is ideal, and it works on all time frames and all indices and what have you. So or at least at the 50 below line or lower. And right now, if we take a look at the SPYs, I'll put it up here on the screen. Let me see exactly where that is traveling. Is right now it's at about the 67. 70 is kind of like represents about an overbought territory. So you want to get at least on a pullback. Now, what you'd ideally do is you'd see that relative strength indicator really line up with coming back into a breakout area. And you pointed it out correctly, which is, January 2nd. And January 2nd to December 31st, that is the breakout area. The question is, on a pullback, do the SPYs come down and test the top, which would be normal, which would be 146.15 of January 2nd? Do they test the bottom of the gap, which would be 144.73, or do they pull all the way back to December 31st out there? The candles, because you're taking a look at it more from a longer-term standpoint, the candles will go ahead and confirm. You can afford to wait one additional trading session and pay a higher price and just have the market prove itself to you. But in my opinion, you took some money off the table. I think you'll find a better entry point, whether it's in the SPYs or whatever it is that you want to make a choice of. You will find a better entry point than where we're at right now. Even if the market breaks out a little bit higher, this is going to pull back.
Okay, so just keep my powder dry for now and wait for a pullback to, at the minimum, the 146 area.
Yeah, I think that's where you're first going to get some type of release of information. And what you've got is you've got some, when it broke out and you've got that gap out there, you've got really nice volume. I mean, you get really nice candle sessions. You had 243 million shares on December 31st, and you had 191 million shares on that January 2nd day. In those days out there, those were holidays. So those volumes are pretty good. Those are meaningful volumes out there, meaningful candles. And watch as volume, if the market pulls back, which I suspect that it's going to, and it's coming down into those areas on lighter volume, 150 million, 140 million, or what have you, that's going to be starting to give you your signals. If it's coming back with volume, or if you get volume off of the top, then that'll be your signal that you would want to wait until the low of December 31st will be tested in that 139 range.
Right. Okay. Any guess about the time frames? Next 30 days or longer?
Absolutely not. I think tomorrow. But
the crystal bar is working for you, huh?
Yeah. No idea on the time frame out here. But I think I will tell you another place where I will tell you in advance this year, because there's some other leading indicators that I use, Bill. You want to start taking a look at as the market moves up into May of this coming year. Sell in May. I think that's going to work again. All right.
Okay.
All right.
Well, thank you.
Thanks so much for calling. Dow is up 22 points. S&P's flat up 80 cents. We'll be right back, folks.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of tfnn.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Great moments are born from great opportunity, and that's what you have here. The opportunity to answer the questions, should I buy or should I sell? Should I be in or should I be out? Hi, I'm Steve Rhodes with TFNN, and I produced a free report, Reading the Message of the Markets, where I'll teach you how to use a set of tools that will answer these questions. Go to the homepage of tfnn.com right now and download Reading the Message of the Markets. This free special report includes step-by-step video examples that would have had you out of the market before the crash of 1929, before the crash of 1987, and would have had you back in the markets buying at the bottoms. This set of tools works on all time frames and all instruments. This set of tools will shape your trading and investing future. Folks, this moment will never be here again. The only cost is not taking action. You were born to be a money master, and the time is now. Go to the homepage of tfnn.com and order Reading the Message of the Markets.
Catch Basil Chapman as he uses his Chapman Wave methodology to call the markets. The Tiger Technicians Hour, next on TFNN.
Welcome back, folks. The Dow up 28 points right now. S&P's up 1. Composite down 46 cents. And one of our den members identified that in the 30-minute chart of the U.S. dollar, Japanese yen, that it was moving through a support level. Now, I believe when we started the show, during one of the segments. We were taking a look at the U.S. dollar, Japanese yen on the 30-minute basis. That's what I've got up on my screen. If it wasn't this show, it certainly was the Trader's Edge show. And we were taking a look at a failed Gartley pattern, a 0.618 Gartley pattern. When you get to a 0.786 Gartley pattern, my experience is when those fail, they will turn into butterflies, 1.272 expansions at a minimum. Now, in this case here, we were taking a look at the 30-minute chart. When it got up to the, when the U.S. dollar, Japanese yen got up to the 0.786 level, which it did yesterday during the 2:30 session here, it sliced right through it like just like a hot knife in butter. And not only did it make a 100% move, it did the 1.272, 1.21 is what you see on my screen if you are watching us. Now, the butterfly patterns, and this is why you want to make sure that you're also utilizing your Fibonacci retracement rulers out here, and add the RSI to it as well. The expected area for a pullback is always going to be sweet 618. That is the dead cat bounce is always going to be that 0.382 level, and then you're taking a look at that 0.618 as being your ideal outcome. And that's an area where you would start to take, if you were in this trade here for any reason, that's an area where you would start to take a look at tightening the stop or maybe taking some money off the table. Now, on the 30-minute chart here, what you can see, getting into that extreme oversold territory, no bulls yet that have shown up, so you'd want to wait for some type of bullish candle. The 0.786 level, no problem for it to move down there. That's right around the 92.50, looks like maybe 92.60-ish range out here. But what you can see is each time, just on the RSI, using the RSA, as on the 30-minute chart that we're looking at, as the U.S. dollar, Japanese yen moves in there, that's an area where you'd be looking for buying this actual currency pair as soon as the bulls would show up here. So on an intraday basis, if you just take a look at the EKG out here, it just says, okay, if you're in this trade, you know what your expectation is out there. Now, how you can use that as well, and this goes back really to Bill in Palm Harbor. Let me go over to one of the show charts here. I mentioned Masco. MAS is the ticker symbol. We never actually got to it, so I'm going to get to it here right now. Masco, beautiful-looking stock chart here from a number of different perspectives. You got several A to B equals CD patterns. You had an A to B equals CD up right from the low of March of 2009. It completed the 1-to-1, decided to go ahead and complete a 1-to-1, 0.272, did it the week of April the 30th. You can see on the weekly basis as it was doing that, also moving up into the overbought territory, just putting these in. So you had a 1-to-1, 0.272, you had a bearish candle, you had the top of the RSI out there, you had everything that you needed. What does Masco do? Masco makes a 1-to-1, A to B equals CD down. It gets into where? It gets into oversold. That's why I suggested to Bill in Palm Harbor, the best place is to go ahead and put your trades on. If you're going to be buying anything, you want to be buying weak hands out there. And sometimes it just requires being very, very patient. But that patience will always pull off. You want to take a look at selling things as Bill actually did. Now, he may not have known it, but he was selling. Well, he didn't sell at the highs out there because before the he was selling during the fiscal cliff marketing things that were out there. But in any event, you want to be selling. You want to take a look at selling something when you get up towards that 70 level, especially when the bears show up, and they'll show up from a candle standpoint. You want to be looking at the bottom. And folks, if you'd like to learn more about that, you can download my free special report, Reading the Message of the Markets Out There. And have a great day. I see we're out of time here. Basil Chapman will be up next. Then we do Victor Jones on Tuesdays from 12 to 1. And then it's the normal cast of characters, 1 to 2, Darryl White, 2 to 3, David White, Daryl Martin, 1 to 2, my apologies, David White, 2 to 3, Ken Shreve, 3 to 4, and none other than the Tom O'Brien Show from 4 to 6. Have a great day, folks. Look forward to speaking to you in the morning. Take care.